It is officially over. For years, the smart money laughed at us. They called us stackers and conspiracy theorists. We sat here, looking at the COMEX data, looking at the empty vaults, and we made a prediction. One day, the paper manipulation would hit a wall of physical reality. We hypothesized that the bullion banks were playing a game of musical chairs with a single silver coin and 10,000 paper claims. But until 8:00 a.m. this morning, that was just a theory. It was a mathematical probability we were waiting to see turn into a disaster. Well, stop waiting. The masters of the universe just blinked and the mask has finally slipped. The body has been found. While most of the world is distracted by the holiday fog, something darker, something systemic, is happening in the plumbing of the global financial system. The mainstream media is silent because this proves the too-big-to-fail banks are, in fact, insolvent. Look at the data that just flashed across the terminal from the Federal Reserve Bank of New York. This isn't a typo. It's a confession. $17 billion in a single morning, right as the markets opened on this Friday, December 26th, the banking cartel tapped the Fed's emergency window for $17 billion in cold, hard liquidity. You have to understand, healthy banks don't go to the Fed's window. That is the walk of shame. It's the financial emergency room for a heart attack. So why did JP Morgan and Citi need a $17 billion adrenaline shot today? They need it because they are bleeding to death. Look at the timing. Overnight, silver didn't just move, it teleported. While the banks were trying to suppress the price at $30, $50, and $70, the market did the unthinkable. It gapped up to 77 and 16ths. The banks are sitting on short positions that represent hundreds of millions of ounces they done to actually own. They thought they could tamp it down like they always do. They thought you would be spooked and sell. But you didn't sell. The industrial buyers didn't sell. And now the COMEX clearinghouse has issued a decree. Pay up or we liquidate you. The banks looked at their vaults, realized they were empty, and realized they were billions of dollars underwater on a mark-to-market basis. They had no choice. They grabbed their last remaining treasury bonds, ran to the Fed, and pawned them just to keep the lights on. This $17 billion isn't a stimulus check. It's a tourniquet on a severed artery. They were hoping you wouldn't notice this on a Friday after Christmas. They were hoping the paper palace could burn in silence. But we see the smoke. We see the game over stamp on their balance sheets. We are witnessing the breakdown of the suppression machine. For the first time in history, the banks have run out of their own ammunition and are using the Fed as a shield to fight the silver market. The green line you see behind me, that's not just a chart. That's the sound of the banking system shattering. In this video, I'm going to show you the exact data points the Fed hoped would stay buried. If you aren't holding physical metal, you're standing on the wrong side of the blast radius. Let's look at the evidence. The silence of a holiday weekend is usually the banking sector's greatest ally, but this morning, that silence was shattered by a digital SOS that should have every American reaching for their physical assets. To understand the gravity of this $17 billion emergency tap, you have to pull back the curtain on the Federal Reserve's plumbing, specifically the discount window and the standing repo facility. These aren't tools for growth. They are the financial equivalent of a break glass in case of firebox. In the sterilized language of central banking, these are liquidity backstops. But in the real world, they are the life support systems for a dying patient. When a bank like JP Morgan or Citi, institutions that boast about fortress balance sheets, suddenly shows up at the Fed AES door at 8 a.m. on the day after Christmas, it tells you that the interbank lending market has completely frozen. Normally, banks lend to each other. It's a closed loop of trust. If Citi needs cash, they call Chase. If Chase needs liquidity, they call Goldman. But when that phone keeps ringing and nobody answers, it means the trust is gone. It means every player on the board knows that the others are sitting on a mountain of toxic, unpayable silver short positions. When the peer-to-peer market dies, the only place left to go is the Fed's emergency window. This is the midnight call, the desperate plea for a lifeline because the alternative is a total systemic seizure by noon. You have to ask yourself why $17 billion was the magic number. In the context of a multi-trillion-dollar economy, $17 billion might seem like a rounding error to the uninitiated. But in the world of margin requirements, it is a nuclear explosion. Banks only tap this facility when they are hours away from a total freeze. Imagine a bank as a high-stakes gambler at a casino. They've been betting against silver for decades, using paper contracts to drive the price down, convinced they could never lose because they owned the house. But suddenly, the price of silver teleports to 77. The casino, computer, the COMEX clearinghouse, doesn't care about your reputation or your suit. It sees that you are $17 billion short on your margin requirement. It sends an automated notification. Post the collateral in 3 hours or we liquidate every single one of your positions. If that liquidation happens, the banks are forced to buy back hundreds of millions of ounces of silver at market price, which would send silver into the hundreds of dollars instantly and vanish the bank's remaining equity. So they run. They don't walk. They run to the Federal Reserve. They take their treasury bonds, the very debt of the U.S. government, and they hawk them like a desperate man at a pawn shop for a few billion in cash just to survive another 24 hours. This is the walk of shame occurring in real time, hidden behind the festive lights of December. This brings us to the most striking image of this crisis, the metaphorical fire at the Federal Reserve. Look at the burning building in the background of our data. That isn't just a graphic choice, it is a representation of the loss of institutional control. For a century, the Fed has maintained the illusion that they are the lenders of last resort, who can manage any crisis with a simple adjustment of interest rates. But the fire tells a different story. It tells us that the suppression machine has overheated. When you try to hold a physical asset like silver down to $20 or $30, when the true demand suggests it should be $100, you are building up immense pressure. You are essentially trying to hold a beach ball under 10 feet of water. Eventually, your arms get tired. Eventually, the pressure becomes so great that the ball rockets to the surface with a force that can break your jaw. The $17 billion tap is the sound of the Fed's control mechanism snapping. The fire represents the fact that they can no longer print their way out of a physical shortage. You can print $17 billion in digital currency, yes, but you cannot print a single ounce of $909.99 fine silver. The Fed is realizing that their digital extinguishers are useless against a physical fire. The game over stamp we see isn't just hyperbole, it's a structural reality. When banks are forced to cannibalize their own treasury holdings to cover silver shorts, we have entered the doom loop. By selling or hawking treasuries to save their silver positions, they drive up interest rates, which makes their other debts even harder to pay. It is a self-inflicted wound that gets deeper with every tick of the clock. This is why the Fed is terrified. If they let the banks fail, the global payment system collapses. If they bail them out with $17 billion today, and likely $100 billion next week, they destroy the value of the dollar, making silver even more expensive, which in turn makes the banks' short positions even more toxic. They are trapped in a corner of their own making. The masters of the universe aren't masters anymore. They are panicked firefighters trying to put out a sun with a garden hose. The institutional control that has governed the market since 1913 is evaporating. While the mainstream media talks about holiday retail sales and celebrity gossip, the very foundation of the US dollar is being incinerated by a margin call they never saw coming. They thought they had forever to cover their tracks, but the physical market just ran out of patience. The midnight call has been made, the cash has been funneled, but the fire is only growing brighter. This $17 billion is just the first spark of a conflagration that will redefine wealth for the next century. If you're watching the smoke and wondering if it's time to move, you're already behind. The fire is here. To understand the sheer magnitude of the $17 billion crime scene we are standing in, you have to understand the nature of the trap the banks set for themselves. A trap built on the arrogant premise that they could sell what they did not own and never intended to deliver. This is the dark art of naked shorting, the primary weapon of the banking cartel for the last 40 years. In a healthy market, a short sale is a legitimate tool. You borrow an asset, sell it, and hope to buy it back cheaper to return it to the lender. But the bullion banks didn't do that. They engaged in a form of financial alchemy where they created paper silver out of thin air. For every single ounce of physical silver sitting in a COMEX vault, these institutions sold hundreds, sometimes thousands of ounces of paper promises. They flooded the market with these digital IOUs to create the illusion of massive supply, artificially suppressing the price and gaslighting retail investors into believing that silver was abundant and unloved. They were playing a game of musical chairs where they sold 10,000 tickets for a room that only had 10 seats, betting everything that you would never actually show up and ask for your chair. But the math of a lie eventually collapses under the weight of reality. The silver short trap was sprung the moment the global market realized the physical vaults were running dry. When industrial giants and sovereign nations stopped accepting paper settlements and started demanding the physical bars, the banks found themselves in a short squeeze death spiral. This is where the $17 billion connection becomes the smoking gun of their insolvency. You see, as silver prices began their vertical ascent toward $77, the unrealized losses on these naked short positions didn't just grow. They mutated into a systemic threat. Because these banks sold silver they didn't have, they have infinite liability. If you short a stock at $10, the most you can gain is $10 if it goes to zero. But your potential loss is mathematically infinite if the price keeps rising. When silver gapped up overnight, the clearinghouse computers looked at the bank's books and saw a black hole. They saw that for every $1 increase in the price of silver, the banking cartel was losing billions of dollars they didn't have in their reserves. The $17 billion emergency tap at the Fed wasn't just a loan, it was the exact amount needed to cover the immediate margin call to prevent the clearinghouse from forcibly closing those shorts. If the clearinghouse had closed them, the banks would have been forced to buy back millions of ounces in the open market, an act that would have sent silver to $200 in a matter of minutes. This is the definition of an implosion. In a typical business failure, you lose your capital and you go home. But when a bank's short position becomes an infinite liability, it doesn't just fail, it vanishes, taking the entire surrounding financial ecosystem with it. The banks are currently caught in a vice. On one side, you have the stackers, the retail and institutional buyers who are taking delivery and draining the COMEX registered stocks to record lows. On the other side, you have the surging price, which acts as a heat-seeking missile aimed directly at the bank's balance sheets. Every time silver ticks up a penny, the paper palace cracks. The $17 billion they just took from the Fed is nothing more than a temporary patch on a hole that has already been ripped open by an iceberg. They are using taxpayer-backed liquidity to fight against the very people, the taxpayers, who are buying the silver. It is a grotesque cycle of self-preservation. The tragedy for the cartel is that the naked shorting mechanism only works if you can scare the longs into selling. If the price goes up and people hold their metal, the short seller is paralyzed. They have no exit liquidity. They are forced to bid higher and higher against themselves just to close their positions, creating a feedback loop of skyrocketing prices and deepening losses. This is why the image of the bank vaults in our narrative shows them filled with nothing but dust and stackers win signs. The physical reality has decoupled from the paper manipulation. The banks thought they were the predators, using their infinite digital printing presses to hunt down the dumb money retail investors. But the tables have turned. The hunters have become the prey, trapped in a cage of their own making, watching as their $17 billion lifeline is swallowed by a market that no longer believes their lies. They are facing a force majeure, or a Smeater event, where they will eventually have to admit they cannot fulfill their contracts. When that day comes, and the $17 billion proves it is closer than anyone dares to admit, the paper-silver market will cease to exist, and only those holding the physical metal will be left standing. The banks aren't just losing a trade, they are losing the ability to dictate reality. The short trap has snapped shut, and the $17 billion is just the price of admission to witness their final act of desperation. The $17 billion panic at the Fed window is the symptom, but if you want to see the disease, you have to look inside the vaults. We have been told for decades that the COMEX is a fortress of stability, a place where the world's silver is stored in high-security bunkers, ready to be dispatched at a moment's notice. But as the stackers win, safe in our imagery suggests, that fortress is increasingly looking like a stage prop. The reality of the COMEX delivery crisis is the terrifying realization that the global silver market is currently built on vaults of sand. To understand why the banks are hyperventilating, you have to understand the shell game they play with the two categories of silver, registered and eligible. Registered silver is the metal that is actually sitting there, cleared and ready for delivery to satisfy a contract. Eligible silver, on the other hand, is just metal stored at the warehouse. It belongs to private owners and is not for sale at the current spot price. For months, we have watched a relentless, systematic drainage of the registered category. The jacks, stackers, from retail investors to billionaire family offices, have been standing on the throat of the banking cartel by demanding physical delivery rather than settling for a fiat currency check. They are taking the bars home, and once that metal leaves the COMEX system, it isn't coming back. This drainage has created a paper-to-physical ratio that is nothing short of a ticking time bomb. Currently, for every single ounce of physical silver sitting in the registered category, there are over 400 paper claims against it. Imagine a game of musical chairs where 4 people are circling one single stool. As long as the music is playing, as long as everyone is content to trade digital contracts back and forth for a quick profit in dollars, the illusion holds. But the music just stopped. When silver teleported to $7,700, the longs stopped looking for a dollar profit and started looking for their silver. They realized that if they didn't claim their physical metal now, there wouldn't be any left. This is the definition of a delivery crisis. The banks have 400 people banging on the door, all holding valid contracts for the same bar of silver. The $17 billion they tapped from the Fed isn't to buy silver, it's to pay people go-away money. They are desperately trying to cash settle contracts, offering premiums to buyers just so they don't have to admit the vault is empty. But the buyers are saying no. They don't want the depreciating paper, they want the God's money that the banks promised them. This has led to one of the most desperate and least reported phenomena in financial history, shadow bailing. Behind the scenes, the too-big-to-fail institutions are no longer just manipulating the price down, they're actively and quietly cannibalizing the retail market to cover their losses. We are seeing evidence of banks quietly buying physical metal from the very retail dealers they once mocked. They are paying massive premiums above the spot price in the shadow market to source physical bars to deliver to their largest institutional clients. They are trying to plug a 400-to-1 hole with a 1-to-1 reality, and the math simply does not work. This is why the Fed had to step in. The banks ran out of cash to buy their way out of this delivery nightmare. They are caught in a pincer move. The COMEX inventory is at a multi-decade low, while the global demand for physical silver, driven by solar, electronics, and a total loss of faith in the dollar, is at an all-time high. The image of the stackers win safe isn't just a slogan, it's a mathematical certainty. When the ratio of paper to physical reaches these astronomical levels, the force majeure clause becomes the bank's only exit. They will eventually have to admit that the vaults are empty, that the sand has run out of the hourglass, and that the contracts they sold were nothing more than expensive wallpaper. The $17 billion liquidity injection is the final, frantic attempt to keep the vault doors closed so the world doesn't see the vacuum inside, but the smoke is already pouring out from under the door. The banks are no longer in control of the silver price. They are in a fight for their very survival against a physical asset that cannot be printed, cannot be debased, and can no longer be hidden. Every bar that leaves the vault is a nail in the coffin of the paper manipulation regime. The vaults of sand are collapsing, and the paper palace is being reclaimed by the earth. The violent green trajectory of the chart behind me isn't just another technical breakout. It is the visual representation of a financial divorce. For decades, the price of silver has been tethered to the whims of the banking cartel's computer algorithms, held in a digital cage of high-frequency trading and spoofing. We've seen these fake-outs before, those agonizing moments where the price begins to climb, hope builds in the community, only to be met by a massive, concentrated smash at 2 a.m. on a Tuesday. Those smashes were orchestrated by a handful of bullion banks dumping a year's worth of global production in digital paper in a matter of seconds, intentionally triggering stop losses and crushing the spirit of the retail investor. But look at the green line now. This move is fundamentally, structurally, and psychologically different. We are witnessing the great decoupling, the moment where physical reality has finally snapped the chains of paper manipulation. This isn't a speculative bubble driven by get-rich-quick mania. It is a flight to safety driven by the realization that the paper currency in your wallet is being incinerated by the very people who print it. The reason this move hasn't been smashed down like all the others is that the banks have finally lost their most potent weapon, the ability to bluff. In previous years, the banks could suppress the price because there was enough physical slack in the system to satisfy the few people who actually wanted delivery. They could sell 1 billion ounces of paper because they knew only 1 million people would ask for the bars. They operated on the assumption that paper is as good as gold, or in this case, silver. But the psychology of the Ein squeeze has shifted in a way the algorithms didn't account for. The protagonist of this story, the retail investor, the stacker, the person who was once mocked as a gold bug, has finally broken the bank's morale. You didn't just buy the dip this time, you took the metal. By removing the physical bars from the system and putting them into private safes, you effectively remove the collateral the banks use to justify their paper trades. You changed the game from a digital poker match, where they held all the cards, to a physical standoff where you hold all the weight. The retail investor has moved from a defensive posture of protecting wealth to an offensive posture of draining the system. And for the first time in history, the predator is the one who is terrified. The banks are currently staring into an abyss of their own making, a mathematical trap from which there is no escape. Usually, when the price of an asset rises too fast, the banks can smash it by selling massive amounts of paper to trigger stop-loss orders, causing a cascade of selling among retail traders who fear losing their gains. But they can't do that anymore. Why? Because the market has become immune to the paper price. If the banks tried to smash the price of silver back down to $30 today, they wouldn't trigger a sell-off. They would trigger a global run on physical metal. The gap between the paper price and the physical price, the premium, is already widening to historic levels. If they artificially drive the paper price lower, the premiums will just explode, and every industrial user from Tesla to Samsung, along with every retail stacker on the planet, will move in to buy every remaining ounce of physical silver at that discounted paper price. The banks are in a checkmate position. If they let the price rise, they die from margin calls. If they smash the price down, they die from a total loss of physical inventory as the world buys the sale. This is the psychological turning point that leads directly to that $17 billion emergency tap. The banks have realized that their smash mechanism is not just broken, it's counterproductive. They no longer have the ammunition, the physical metal, to back up their paper threats. In the past, they could move the market by moving the sentiment, but you cannot move the sentiment of a person holding a 100-ounce bar in their hand. That person knows what they have. They know that no matter what a screen in New York says, that bar is still a 100-ounce bar. This resilience has paralyzed the trading desks at Citi and JP Morgan. Every time they try to suppress the price, it only serves as a signal to the world that silver is undervalued, triggering even more physical buying in a relentless, self-reinforcing loop. It's a feedback loop that the banking cartel cannot escape. They are watching the green line move vertical, and for the first time, they are powerless to stop it. The morale of the old guard has collapsed because they are fighting against a force they cannot manipulate, the laws of mathematics and the absolute scarcity of the physical world. For years, they thought they were the masters of reality because they controlled the digital representation of wealth. They forgot that the representation is not the wealth itself. The green line represents the truth that you can print 17 billion in a single morning, but you can't print the silver needed to settle the debt. You can't print the silver needed for the solar panels or the electric vehicle batteries. The decoupling is here, and the paper palace is being left behind in the dust of a new physical-led reality. The green line isn't just a chart, it's a scoreboard, and for the first time in a century, the banks are losing. They are watching their influence evaporate as the world wakes up to the fact that the emperor has no silver. This vertical move is the final signal that the suppression era is dead. The banks are now merely spectators in a market they once ruled with an iron fist. They are watching the wealth they tried to suppress flow into the hands of those who had the courage to see through the paper lies. The $17 billion is their admission of defeat, a desperate bribe to the clearinghouse to keep the game going for just one more day. But the green line doesn't care about bribes. It doesn't care about the Fed. It only cares about the fact that there is more paper than metal, that the bill is finally coming due. The Federal Reserve is currently staring into a mathematical abyss, trapped between two choices that both lead to the same catastrophic conclusion. This is the doom loop, in its final, most lethal form. On one side, the Fed could choose the path of austere discipline. They could refuse the $17 billion bailout, let the interbank market freeze, and watch as JP Morgan and Citi are forced into a chaotic, uncontrolled liquidation of their silver shorts. If they did that, the banking system would disintegrate by the time the closing bell rings. Every ATM would go dark, every digital transaction would fail, and the too-big-to-fail institutions would be revealed as the insolvent husks they truly are. But the Fed cannot allow the banks to die, because the Fed is the banks. So they choose the second path. They open the spigots of QE Infinity 2.0. They print the $17 billion today, knowing full well it will need to be $170 billion by next month. They are choosing to sacrifice the purchasing power of every single dollar in your pocket to save a handful of criminals who bet against a physical metal they did not own. The profound irony of this rescue is that by saving the banks, the Fed is actually guaranteeing their eventual destruction. To provide that $17 billion in emergency liquidity, the Fed must expand its balance sheet, effectively devaluing the US dollar in real time. This massive injection of new currency acts as a high-octane accelerant for silver prices. As the dollar weakens, the price of silver, measured in those very same debased dollars, must rise to reflect its true scarcity. When silver moves from $77 to $85, then $90, then triple digits, the bank's short positions don't just become expensive. They become a terminal cancer. The very money the Fed prints to save the banks from a $77 silver margin call is the same money that will drive silver to $120, creating an even larger margin call that requires even more printing. It is a self-reinforcing cycle of hyperinflationary madness where the cure is actually the poison. Each round of liquidity makes the paper palace more unstable until the ratio of paper claims to physical ounces reaches a point where the entire ledger simply breaks. This brings us to what I call the nuclear detonation of the US dollar's purchasing power. We are no longer talking about a slow 2% annual erosion of your wealth. We are talking about a vertical drop in what a dollar can actually buy in the real world. Think of it like a bridge that has suffered decades of metal fatigue. It looks stable until the moment the first support beam snaps, and then the entire structure falls at free fall speed. The $17 billion confession at the Fed window is that first support beam snapping. The world is watching the masters of the universe hawk their last remaining treasuries for cash, and they are drawing the only logical conclusion. The dollar is no longer a store of value, it is a liability. When the market realizes that the Fed is willing to print infinite amounts of currency to support a failed manipulation of the silver market, the global exit from the dollar moves from a trickle to a stampede. This is the game-over moment for the global reserve currency. As foreign central banks and industrial giants see the Fed entering QE Infinity 2.0 to protect a silver short, they begin to dump their own dollar holdings in favor of the only thing that cannot be printed, physical assets. The purchasing power of the dollar doesn't just decline, it experiences a total loss of confidence. The nuclear detonation occurs when the average person realizes that the money in their bank account is being used as a weapon against them to fund the very bailouts that make their groceries and fuel unaffordable. The $17 billion isn't going into the economy. It is going into a black hole of bank debt to prevent silver from reaching its true value. But you can't suppress the truth forever with a printing press. The explosion of the silver price is simply the light that follows the detonation. The blast wave is the sudden, jarring realization that the dollar has become a ghost of its former self. We are transitioning from a world of infinite paper to a world of finite reality, and the $17 billion bailout is the siren that signals the end of the old era. The Fed is not putting out the fire. They are pouring gasoline on it and calling it a liquidity facility. The doom loop is complete, and the only escape is through the vault door of physical ownership. When you look at the game over stamp flashing across the digital monitors of the global financial elite, understand that it is not a declaration of a temporary market dip or a routine cyclical correction. This is the terminal diagnostic for a century-long debt-based fiat experiment that has finally run out of runway. For decades, the high priests of finance, the masters of the universe occupying the C-suites of J.P. Morgan and Citi, operated under the arrogant delusion that they could manage the world as wealth through an infinite loop of digital IOUs. They believed that by controlling the screen, they controlled reality. But they forgot the most fundamental law of the physical universe. You cannot eat, build, or power the future with a digital promise. The $17 billion emergency tap. At the Fed window we witnessed this morning was the structural integrity of the paper-silver market finally snapping under the weight of its own lies. This is a structural reset, a violent, irreversible transition from a world where price is a fiction determined by a bank's computer algorithm to a world where value is a fact determined by the physical weight of the metal in your hand. The roadmap to $100 silver is no longer a conspiracy theory or a moonshot projection. It has become a mathematical inevitability dictated by the laws of supply and demand that the banks tried to outlaw. To understand why $100 is now the floor, you have to look at the reinforced concrete ceilings the banks built over the last 40 years. They used trillions of dollars in paper shorts to keep the $30 and $50 price levels intact, treating those numbers like a psychological cage for investors. But as the $17 billion margin call proves, the structural supports of that cage have buckled. Once a commodity like silver, a metal that is simultaneously a monetary asset and an indispensable industrial component, breaks through a 40-year manipulation ceiling, there is no resistance left above it. We have entered blue sky territory. Consider the trifecta of unstoppable forces currently converging on the silver market. First, we are facing a 200 million ounce annual supply deficit that is being ignored by the mainstream media but felt acutely by the vaults. Second, we are in the midst of a green and digital revolution where AI data centers, massive solar arrays, and electric vehicle fleets are consuming silver at a rate that mine production cannot possibly match. Third, and most importantly, the paper-to-physical ratio has reached a breaking point. When you have 400 paper claims fighting for the same single physical bar of silver, the price doesn't just rise. It undergoes a phase shift. It teleports. In this environment, $100 is not a destination. It is merely the starting line for a new monetary dawn where physical assets reclaim their throne from digital illusions. This leads us to the most critical crossroads of your financial life. For the better part of a century, the average person has been a victim of the banking system. You have been a passive observer as your savings were eroded by the invisible tax of inflation, and your assets were manipulated by institutions that treat the global economy like a private, rigged casino. They wanted you to stay in the paper lane, keeping your wealth in digital accounts where they could use it as collateral for their own reckless bets against the very assets you should own. But the collapse of the paper-silver market offers a rare, once-in-a-century opportunity to move from victim to victor. The victors of the next decade will be the ones who realized before the masses that wealth is not a number on a banking app that can be frozen, diluted, or erased with a keystroke. True wealth is a physical reality. By moving your capital into physical silver, you are effectively opting out of the Fed's doom loop. You're taking your chips off the table and placing them in a safe that the banks cannot reach and the Fed cannot print. You're moving from a system based on counterparty risk to a system based on intrinsic value. When the banks ran to the Fed for $17 billion this morning, they weren't just asking for cash. They were admitting that they no longer have the stuff. They have the paper, but they've lost the metal. The call to action is simple, yet the window of opportunity is closing with every tick of the clock. Physical ownership is the only bridge that leads out of the burning building of the global debt market. As the banks scramble behind the scenes to source physical metal from the retail market, engaging in the shadow bailing, our operations we discussed, they are signaling their absolute terror. They are terrified of you owning what they cannot create out of thin air. They know that every ounce of silver held in private hands is an ounce that can no longer be used to suppress the price or maintain the illusion of their dominance. This is the ultimate squeeze, not just a move on a chart, but a fundamental reclaiming of financial sovereignty by the individual. The game over screen is only for the institutions that built their houses on sand. For the people holding the physical metal, the game is finally becoming fair. The smoke from the $17 billion fire at the Fed is clearing, and what lies on the other side is a world where silver is revalued to reflect its true scarcity and its essential role in human progress. The roadmap is clear, the evidence is undeniable, and the destination is $100 and beyond. The new monetary dawn is rising, and for the first time in history, the people who had the foresight to stack are the ones who hold the keys to the vault. When the history books look back at the Friday after Christmas in 2025, they won't remember the holiday sales or the celebrity news. They will remember it as the day the masters of the universe went broke trying to fight a metal they couldn't control. They will remember it as the day the $17 billion confession signaled the end of the paper era. You have seen the smoking gun. You have seen the evidence of the insolvency. Now, the only question that remains is, which side of the vault door will you be on when it finally slams shut? The transition from victim to victor begins the moment you exchange a failing currency for a timeless asset. The game over stamp has been pressed. Make sure your wealth is positioned for the new game that is about to begin. We are moving into a period where liquidity will mean nothing and solvency will mean everything. The Fed can provide the former, but only physical silver can provide the latter. The era of the paper palace is finished. The era of the stacker has begun.